Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glancepay.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle, and thanks for taking time out of your vacation to speak with us.
Yeah, hi.
The Ontario realty market, as I say right now, it's Ontario, airy, scario. Are people now getting the feeling that perhaps paying the highest prices they've ever seen for real estate in Ontario may not be the best of ideas?
Well, you would think, but I'm not so sure. I think there is some recognition coming into the marketplace. We've certainly seen prices slump or weaken. Sales average prices have come down about 20% or so since April, when it was sort of at the peak. But let's not forget that, you know, between 2016 and April of 2017, prices in this area around, you know, the Greater Toronto area sort of thing had gone up about 40%. So even though they've retraced, you know, something like 20% in terms of the average sale price over the past few months, they're still even up over the last year. So really, I think, you know, it's probably a start in a mean reversion process that's been long overdue. But as you've seen in Vancouver, it can come in fits and starts, right? So you can see you guys had a downturn, slowing sales and all that good stuff, and then, you know, recently in the past month or so, there's been some firmness come back into pricing. Does that mean that the, you know, necessary correction or mean reversion part has completed? I don't think so, but it's certainly, you know, it's been such a long extended boom in prices in Canada. I think that it's hard for people to wrap their head around a changing climate. And, you know, I mean, I talk to realtors all the time. A couple are good friends, and they say, you know, hey, the realtors have figured out that the price cycle has changed. It's certainly, but the clientele, the people looking to sell, still have their heart set on top dollar. You know, they've still done the math in their head from where somebody sold last spring, and they think that they should be able to get that same crazy multiple for their property. And in fact, you know, the buyers have just dwindled. The supply has, in some cases, it's literally up 50 and 60%, from, you know, say March. So there's a lot of motivation for people to try and sell at this point. I say that if you back up, that's demographically driven. That's people wanting to cash out. It's the aging population, low yield environment where everyone's saying, gee, you know, my savings for retirement are yielding much less than I'd hoped. You know, our expenses here are pretty pricey. Let's try and downsize some of our costs, free up some more savings for living on. And, you know, so everyone's kind of got that idea at the same time. But at the same time, you've got just, you know, prices got so far above the average income in terms of a multiple, you know, 5, 6, 7, 8 times when a normal is about 3, that the average person is struggling even just to get into the property market. What I think is really quite interesting is, you know, because of the credit bubble and because the aging demographic, the boomers were the ones that had the most sort of highest priced real estate in the past few years. They've come to be the owners of the most expensive real estate. You're really seeing that the high-end properties actually are the ones that are seeing the least appetite and the biggest declines in price, which makes sense to me, right? Because young people still want to get in. There's still a household formation desire in many parts of the country where young people are wanting to sort of set up shop, set up home. But it's those really high-end prices, you know, more than $800,000 that are just not not nearly turning over in the way that they were. And in some cases, people have indeed lowered the prices, which is, the first you always get the decline in sales volume, the increase in inventory, and then for a while people sit on their properties and sort of think they'll wait this out. And then eventually you get people that actually do need to sell, or, because they have leverage and too many bills, or because they just need to reduce their holdings, they eventually do decline prices. And that's what we're seeing in this area north of Toronto just in the last month. We've seen people literally mark down prices by 20% and still not selling. So very interesting. We'll see if this is the thin edge of that wedge that's been so long overdue. I was writing on the blog this week about, there's so many factors, right? There's, as I say, the demographic debt balloon that's weighing down affordability. There's the disruption of capital flows out of China, which was, something like 10 to 20% of the buyers in Canada the past few years have come from foreign, like non-nationals, buying properties. And, with China having a debt bubble of monstrous proportions at home and their reserves dwindling as they try and continually reinflate their own economy, they've now really cracked down again on capital flows, and there's an 82% reduction in the amount of money leaving China in 2017 so far over the prior year. So obviously that too, there was at the margin, there was this foreign buyer that has now been dissuaded partially perhaps by the foreign tax that's been brought in some jurisdictions, but certainly through the curbs, which are declining the amount of money that's able to leave Asia. So all those factors together, I think, are setting us up for the downturn that we certainly need to get affordability back into shelter in this part of the world.
We'll have more with Danielle Park right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Welcome back. We're speaking with Danielle Park. Danielle, do you see much effect to the economy right now with the war of words? At least now it's just words between the U.S. and North Korea.
Well, I think that we have had a long period of great complacency and ignoring of the risks in the world. And I think that as in every cycle, when you get those long periods of not looking at what can go wrong, all of a sudden there's a trigger of some kind. So whether it is this, rhetoric about North Korea and whether we're going to get into, some kind of a bomb exchange, which is a pretty terrifying concept. But I think that, whether or not that happens, this was a market looking for any excuse to wake from its slumber. And I think that, whether it's an economic shock of some kind, or a geopolitical shock, whether it's an oil shock where, everyone who's been assuming oil prices would rebound any day shortly, and then if they don't and indeed begin to sell off again, any of those things, a default cycle, the credit default cycle has really spiked in the past few months, and we keep seeing more and more bad debts coming into the system. Any of those things could be an excuse, any and all really together. But we're certainly so overdue for a realization that the world is full of risk, that uncertainty is with us every single day, and these phases where we see everything in rosy glasses or rosy terms always come to an end and sort of have a abrupt point where everyone says, oh no, what were we thinking? Why don't we have any savings and cash set aside? Why have we got all these really ridiculously priced assets? Why don't we have, why have we got so much debt? All those things that leave you vulnerable when you get into a challenging period. And I think this may indeed be one of those catalysts that just sort of wakes people from their slumber. We're seeing that with the volatility index, which again has been, was below 10. And it has been just an indicator of apathy across the board. That people think, that they can pay any price for anything and it'll all work out. And of course, that's all not true. That's never been the case. And so something jars them to their senses. And we've seen, for example, just today, the VIX index, the volatility index spiked 30%. So, we need a lot more of those days. This is very early. We're still just modestly from the peak in the S&P 500. But in the Canadian market, we're back buying below 15,000, within shot of 15,000 again. So we're already below where we were in 2008. That was, just in the last month we were back below where we were in 08. And so now we're negative year to date. And, the downside from here from Canada is we're already at full employment. Everyone's talking about, oh, isn't it wonderful that we have unemployment, 4.4% unemployment in the United States. The fact is, though, that that's a cycle, and every time we get down to that level, that's about as good as you can ever get in any economic expansion. So all those things are just backward looking to tell you, hey, you're probably through the peak of this business cycle, and you're way past, normal, or you're into ludicrous territory in terms of the valuation cycle. Debt levels, corporate debt's at an all-time high, household debt's at an all-time high, government debt's at an all-time high. So when it can't get any better in terms of revenue, another very interesting metric which we have always followed is the median price to revenue ratio of the S&P 500 companies today. The median price of the shares relative to the revenue that's coming in is at 2.5 times. That's an all-time high. It only ever got to about 1.75 times in 2007 and even less in 2000. And yet when we look back, everyone says, well, everybody knows 2000 was a crazy bubble. It was a, financial bubble that went crazy bad. And, well, everyone knows 2007-8 was a credit bubble worldwide. It was a disaster. Well, we're way past there, folks. So now's the time to wake up and smell that coffee, I think.
We'll have more with Danielle Park right after this.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer Gold Mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. We're talking with Danielle Park. Is one of the problems right now, because money still is relatively cheap, that the big corporations that were borrowing money to buy back their shares are still doing that?
Yeah, Really, it's the end of a 30-year cycle of credit abuse, which was only interrupted for a short period of time by the 2007-8 collapse, and then quickly reinflated by central banks and a concerted effort to get asset bubbles back up. So really that behavior, those 3 decades of, add more debt and stir, increasingly degrading the balance sheet, trading savings accounts for lines of credit, the belief in, taking sales advice, taking financial advice from salespeople who are paid to get you into risk. That whole 3 decades of that has really just degraded us on every level of financial stability and strength. And so you've got this emboldened finance sector. You've got banker pay back at all-time highs. You've got them calling, I just, for example, noticed that the fiduciary rule that we've talked about before, Jim, that was, proposed and was supposed to come into effect this January that requires financial advisors to put the best interests of their clients ahead of their own commissions and profits on products has been now delayed another 18 months. So with all this nonsense about, talk about Trump coming in and taking the system back from the bankers and supposedly, championing the little guy and the worker, all nonsense. The government's completely still controlled by the financial cartel. They're still convincing regulators that it's inappropriate or unfair or, somehow disastrous to expect them to put the best interests of the people first that they're supposedly advising, right? So we're really in this, we've really made this bed and we're lying in it through lax regulation and abuse of credit and letting the bankers and finance take over and run the show. So we really have to face a lengthy time now where that genie is put back in the box. And I think the catalyst is simply going to be a bear market in stocks. I mean, we would just need a sort of 30% decline to be back to where we were 17 years ago in terms of, even the U.S. stock market, which has gone up the most on QE since 2012, the most in the world. It's been the best performing stock market, but you just need that kind of a decline to put you right back where you were, 17 years ago and even further. So the next market decline is going to evaporate in a matter of months what people have thought were gains that they've accumulated since, the last bottom in 2009 as the markets have recovered. But each time we get one of these blow-ups, this will be the third time now in the last 20 years, every time we get that, the market is set back at least 12 years. So in other words, you would have been better off sitting in cash the entire time, taking zero risk. You'd have made more money than doing all these really aggressive speculative things that people have been preoccupied with during this period. So it's been a very wasteful, unproductive time. And spinning wheels and, looking like you're getting ahead only to fall farther and farther behind. We're seeing that in deficits everywhere. We're seeing that in pensions everywhere. So it's what we really need is even just a run-of-the-mill bear market decline of 25 to 30%, which would be extremely benign. And in all these circumstances, that would be the best possible or the least possible decline anyone should expect. But just that much. This system is so highly levered and people are so unprepared that just that amount of downside is going to be like a meteorite hitting the planet in terms of the financial stability and instability that will cause. So I think, I just would love people to realize how precarious this is, try and take steps now to lower their risk and lower their debt and build up their cash and their liquidity, because there's going to be hardly anybody in a position of strength to buy when this thing finally corrects. And you want to be one of those people. That is the only way you can't control the cycles you're given, right? We're born into a time, we come to maturity in a time, we have savings when we have them. That's kind of the way our life cycle works. And we're headed towards, the end of our life cycle. We don't get to dictate any of that. What we can control is the way that we personally behave and the choices we make, and what exposure we are prepared to take on at which part in this market cycle and business cycle. So, it is a cycle. That's job number one. If you don't understand that these things are cycles, then you're in big trouble, right? Because then you're constantly thinking you can do the same thing. It's a perpetual upswing and you never have to adjust anything. That's a disaster. So first of all, it's understanding that this is a cycle, then devising or deciding how you're going to manage your own personal risk through that cycle, given the reality of it. And then once you've chosen your approach, you have to have the strength to stick it, because it takes what it takes to complete. But because it takes 3 years longer or less than you thought doesn't mean that you change your course. You've already devised your rule set. You need to stick with that. So just because value's been out of favor and everyone's been doing very self-destructive things and, gambling at the casino doesn't mean that you should, doesn't mean that you can afford to lose. And the worst possible thing that people do right now is they think, well, I don't have enough savings yet. I'm not as rich as I want to be yet. Therefore, I've got to take lots of risk. That's totally devastating. That's the wrong mindset completely. If you have less savings than you want, then you can afford to take less of this kind of speculative approach because you can't afford to lose capital at all in those environments. So it's just, I'm really looking forward. I say, value's been in a long winter. Like anyone that's concerned with discipline and making sure they don't do crazy things with money and look for investment merits, that's been out of favor now for 5 years, really. I mean, it started in 12 when the QE started with a vengeance worldwide. 2015 value did better because the markets went down. But basically, we've had 4 years here where it looked like there's no point in doing any math, or who cares about what you're paying, or who cares what yields are, all that. And every time we've had that kind of a period in history, we come through it to a period where value becomes king again. Those with cash, those with liquidity and strength are in the driver's seat again, and everybody else falls back by, as I say, many years. So you have to decide how you want to approach this. This is the reality of what we're in. And I just think it's better to make a plan that protects your own assets since you can't control the madness of crowds.
Danielle, thank you so much.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for our guests or for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.